Welcome to Investors Insights. Our topic today is Masters and the Markets. We chose that title. We're coming off the Masters tournament, and we all thoroughly enjoy not only the history of the Masters, the tradition, but also from the standpoint of the professionalism of these athletes as they're out there showing us how bad we really play the game. And that said, though, the markets can do that to you as well. In this type of market we're in right now, there's a lot of variables. And just like a professional golfer, it could be the wind, it could be how the roll of the green is. So there's multiple reasons. And we're going to talk about our multiple reasons that we see as we move forward this year. Throughout the year, we've talked about inflation. We're going to continue that discussion. And we're even going to talk about April seasonality. So with that, my distinguished colleagues, Trey Booth and Tom Miller, have joined me. And we're looking forward to bringing you up to date on things we think you need to be focused on for the week. Trey, why don't you start us off?
Yeah, absolutely. Thanks, Greg. So as Greg alluded to, and we've talked about on this vlog often, is that we're heavily focused on inflation and inflation data. And why is that? It's because that is driving the Federal Reserve, and the Federal Reserve is driving interest rates. And those interest rates impact people getting a mortgage. They impact companies borrowing money. And therefore they impact companies' earnings. And so it's all one leads to the other. And so it starts with inflation. Last week we got a number that was a bit disappointing to the market, but something we expected, where inflation came in at 3.48% CPI, Consumer Price Index. That is not near the highs of over 9% we saw over a year ago. But it's still well above the 2% target that the Fed has. And what's stubborn about it is that it's not rising much, but it's also not falling. So we're just kind of stuck in this 3 to 3.5% range. And so what that is causing that's causing the market to expect what's called higher for longer. And so you can see on this chart what it does, that it compares two lines of where the start of the year we thought where the market thought the federal funds rate and therefore interest rate to be. You can see that expected interest rates to go down in a pretty swift line. And then the top line is where they expect them to be now. It's pretty flat. The market went from expecting 6 rate cuts to now less than 2 in this calendar year. That's more in line with where we were, because we felt like, based on what we've seen in history and based on what the inflation was, that the Fed would have to stay higher for longer to beat back inflation. Because what happens in the past is the Fed would win, inflation would come down, they would cut rates, and then inflation would come back up. And history doesn't repeat itself, but it often rhymes. And if you can avoid that rhyming in a negative way, that's very important. But what's more important is how that's now starting to impact corporate America and treasuries. Treasuries move quickly because they're really much more liquid market, and the federal government is always borrowing. So the 2-year treasury from the February low inflation print has moved from 4.2% all the way up to 4.97%. The 10-year treasury moved from 3.87% all the way up to 4.55%. I mean, you have a $32 trillion deficit. These little moves are expensive.
It adds up.
It starts to add up. But on this next chart, what I want to show you is where it's really starting to add up for corporate America. And what this is the average percentage paid on debt by the S&P 500 companies. Those are the largest publicly traded companies in the U.S. You can see that it's currently at 4.2%. That's considerably less than what the U.S. government's borrowing for 2 years at 4.97%. Why is that? It's because, like many homeowners, when interest rates plummeted in 2020, 2021, corporate America refinanced, and they extended the duration of their loans. So they don't have to feel the pain of higher rates until they have to refinance. But what this chart is showing, you can see that on the bottom right, where it's shooting up from below 3 to 4.2, that's showing that they're starting to feel the pain of higher interest rates. And the longer interest rates stay where they are, even if they don't go up, they just stay flat, more and more of corporate America is going to have to refinance at these higher rates. It's not an egregious spike. We're not going to spike to 7, 8, 9, 10%, but it's going to start to be felt. And we'll see that in earnings calls that CFOs are going to have to announce that they're refinancing debt that they had locked in at 1, 2, 3%, now at 5, 6, 7%. So something we're going to have to watch closely. If rates stay flat for longer, that's when it really starts to hit corporate America as they have to refinance.
Yeah, and I think that's a great explanation and great insight. It also, going back to the golf analogy, you get on the golf course and the terrain changes, or you think you've got your game plan and you have to make adjustments. But throughout our blogs, since last year, we've talked about, as you stated earlier, that we just didn't see the Fed really dropping rates. And as we continue on this journey, I think we're on target there. We're going to hit the green, if I can use that analogy. So with that, Ty, you talked about April seasonality, and I thought it was very appropriate, tied into what Trey was talking about. Elaborate on that.
Yeah. So technically speaking, April is one of the strongest months of the year. Average, gain of about 1.5%. Again, this is the S&P, and then, it's up about 70% of the time. So April's traditionally a very strong month. One interesting aspect is that a lot of that strength doesn't happen until after about the 15th of the month. So in the latter half. So we've kind of had a bumpy start here to April this year. Not uncommon. A lot of that strength comes after the 15th. And then, of course,
which happens to be around tax day. We might
right,
have.
Yeah, right around tax day. Oddly enough,
it's all our wallets started to shake a little bit. The withdrawal. Oh, tax.
Yes, the withdrawals paid. Now you can start
investing. Yeah. And then, I don't know if a lot of people know, but the S&P's been on a 5-month win streak. And so, I think for value investors, a lot of times you're looking for opportunities out there, and certainly we are. But a lot of times strength, begets strength. And so here's a chart here showing that following a 5-month win streak, what the market kind of does 1 month, 3 months, 6 months, 12 months, later. And it's positive a lot of the times. So, just some factors to keep in mind. Again, technically speaking, April is very strong, but that doesn't account for an election year this year. It doesn't account for the fundamentals that Trey just mentioned with interest rates and inflation. So there's a lot of factors that go into it. It's just kind of a one piece to the puzzle here.
Yeah, but from a historical standpoint, it's nice to know that data. The example I would give, it's like the golfer that's going back to the Masters for the 10th time. He thinks he knows the course. Mm-hmm. You have a feel for it. And historical data is very important, but it's also good to watch after the 15th as to, where we see strength coming in. So, well, folks, we hope we've given you some insight. We hope you'll be watching after April 15th and how the markets are doing based on what Ty just shared. And also from the standpoint, the dialogue and news that's coming out in regards to inflation and what the Fed's doing with interest rates. And rest assured, we here at Five Plan Partners are going to be watching all of it. And pulling all that data together on a regular basis. And we're going to bring it to you through our vlogs, our social media, LinkedIn, Twitter, Facebook, YouTube, also on our podcast. Really appreciate all the feedback that we're receiving regarding the way we're communicating that kind of information. As I've said before, we're frustrated educators, and the more knowledge we can give you, the better. So with that said, we hope you have a great week. And know that here at Five Plan Partners, we're striving every day to see to it that you have a better, richer, fuller life. Thanks.